Hello, my name is Phil. I'm an investment professional. I have 20 years of experience in the finance industry. About a year ago, I launched my own registered investment advisor firm during the midst of COVID. And so what we'd like to talk about today is about the acquisition of Afterpay by Square. This video is a couple of days old. So this is my first video. So go ahead and click the like and the subscribe button if you do like the content on this video. And I'm going to try and post as much as I can, hopefully a couple times a month, eventually, hopefully at least once every week, give you a breakdown on the important financial news in the markets. So if you look at my screen here, the acquisition is for about 39 billion in Australian dollars for Afterpay, and Square is acquiring Afterpay, and they're using stock for the transaction. So in risk arbitrage, what this means is that this is a transaction, and the things that are important that you look at is the probability, how likely the deal is going to close, and then also the time frame. Because if you're going to earn, say, a 4% rate of return between now and a year from now, that doesn't sound too enticing. However, if it's going to close in 3 months, then your annualized return is not 4%, 16%. That becomes more attractive. So Morningstar says it's due to close in the first quarter. So let's assume, just for hypothetical, that it's going to close roughly 6 months from now. So based on where Afterpay closed a couple of days ago, it was roughly around 37.4. I guess today it closed 37.1 Australian. So you got roughly 4 to 5% upside. Now annualized, that's high single digits. And Morningstar assigns, let's just go with their numbers. They use a 75% probability weighting that the deal will go through, and a 25% it won't go through. A quick disclaimer, this video is for education and entertainment purposes only, and I'll have a disclaimer there down below. So I created just a basic Excel spreadsheet here. So the probability of the deal going through is 75%. Again, it doesn't go through 25%. Now the stock is a little bit below 100 before the acquisition. So let's say you have 30% downside. And again, as I mentioned, you have roughly 4% upside from here. So if, let's say you're going to use $1,000 investment and you're going to make 4%. Well, that's $40 times 0.75 is $30. And the probability of the deal falling through, that's let's say you lose 30% of 1,000, that's 300. Multiply that by the Morningstar weighting of it not going through, 25%, so that's $75. So as you can see, you can make 30 and you can lose 75. So that's the negative expected value. Whenever you're doing probability expected value, you want to make at least for it to be positive. And so this is a deal that probably would not be a good investment. So just based on the math. Now, at some point, if I go back to the screen with the Afterpay stock, it was trading after the merger. It dipped down to 117, 116. So the market cap went down to, let's say in the low, around 33 billion or something like that. Now, at that point, your expected return would have been double digits. And then when you analyze that, you're looking at into the teens, or the 20s rather, low 20s. So that's obviously a lot more attractive. It's certainly, the lower the price that you can get the acquisition, the more attractive it's going to be. So that's all I have for today, and I'll post more videos. Again, click the subscribe button below and the like button, and appreciate your time.